What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Today, my guest is Chief Investment Officer at 2 Prime Digital Assets Fund, Nathan Cox. Really excited to speak with Nate today. As many of you know, I've talked about this quite a bit. I've been day trading cryptos for some time, but actually getting more into it now as of late, mostly Ethereum. As many of you know, CME Group has recently launched Ethereum futures. And I wanted to speak with Nate today because he actually comes from the futures day trading side of things and then became a hedge fund in crypto. And he pretty much is day trading this stuff, managing it at least on a day-to-day basis. So it was really important for me to get the perspective of what somebody like Nate, who's trading a lot of size in Ethereum and Bitcoin, how he trades these digital assets. We talked about everything from how he's getting fundamentals on Bitcoin. That's right, fundamentals on Bitcoin. I didn't know there was such a thing until I spoke with Nate today. Talked about his technical analysis and really just how he goes about executing his trades in crypto. If you're someone who day trades crypto or is investing or trading crypto, I think you're really going to enjoy this episode with Nate. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. You can listen to Futures Radio Show podcast anywhere podcasts are available. But if you want to watch Futures Radio Show, you can check us out on YouTube or on anthonycrudele.com. This show is also sponsored by Trading Technologies, TradeStation, and FTSE Russell. The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-mini Russell 2000 futures symbol RTY and micro E-mini Russell 2000 futures symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. Nate, what's up, buddy?
How's it going?
Good, man. Thank you so much for joining me today. I feel like it's really crypto week on the show. I just got done doing a show the other day on crypto. We're doing another one today on crypto. And with everything that's going on in the markets, you know, there's just so much to talk about in crypto right now. All this volatility we're seeing.
I know it. It's been wild. I mean, I feel like every week is crypto week, but that might just be where I am right now. So, but yeah, I really appreciate you having me on the show. I'm super excited to talk, and yeah, I know there's a ton of stuff to cover right now.
Yeah, I mean, there's just so many things going on right now in the world, and really the crypto market is a lot what we're going to focus on today. And one of the interesting things that I found about you and your story and why I was excited to speak with you today was you really started as a day trader. You started trading derivatives at 16 years old. So you come from the traditional finance side, which is so many people now have gone from the traditional finance side to the crypto side.
Yeah.
And so you understand markets and you understand trading. And now you're running a hedge fund where you're one of the bigger players out there trading Ethereum and Bitcoin every day. So I really am interested to hear, because I'm still on the day trader side, but I'm trading crypto now. And you're running a hedge fund where you're trading, you know, a lot of size in Bitcoin and Ethereum. And I want to start off with really how that transition was for you.
Sure. Yeah. I mean, you know, it's been a long road to get here, but obviously just starting as a derivative trader, I think I probably started off, felt like I was going 100 miles an hour just because, you know, when you're trading options, and I was obviously pretty young when I started, you know, you feel some pretty epic swings from highs to lows, just in terms of, you know, you have this sort of exponential buying power when you're trading derivatives, but it also means you have exponential losing power. So I think I got accustomed to volatility at a pretty young age, and it helped me throughout my career. You know, after I started day trading, I moved into working on a derivatives desk at a small family office. And that's really where I started to cut my teeth and learn a little bit more about some spread trading and that kind of stuff. But ultimately, it's really what helped me create that sort of disciplined mindset that you have to have as any kind of trader. It doesn't matter what the asset class is. It doesn't matter if it's derivative stocks, you know, bonds, futures. You just have to really develop that mental discipline and toughness. And now, of course, coming into the cryptocurrency world, that is, so important, just because you have these wild swings. Yesterday and the day before, we've got a 33% drop in Ethereum from peak to trough. We've got a 23% drop in Bitcoin in 2 days. So if you're not, if you're not seasoned, these things can really shake you. And obviously, what's happening in these types of moves is you're having a lot of, I'll say, retail traders that are probably getting shaken out of these positions. They get caught in the hype cycle of Tesla announcements and Michael Saylor and price going through 50,000 and all this kind of stuff. And it's easy to get caught up in that kind of stuff. So it's really something that I try and take with a grain of salt when I see those types of moves, because it's just, my history says that something going up 85% in a month isn't normal. And, it just isn't, it isn't normal, right? That's the classic too fast, too far, too fast. And when we see that kind of stuff, I try and lean on some of my experience. And that really goes back to building a frame set of data that I'm analyzing, and, what kind of a standard deviation move did we just see? And here's why I'm actually shorting at these kind of levels, or, adding some short premium when we get into that sort of nosebleed area. But that's sort of, that's where I've come from, and how it's certainly helping me in the cryptocurrency space.
Yeah, I started off with that today because me being on the day trader side, I've been doing it for a long time, getting into crypto, the hardest thing for me to adjust was understanding volatility, because as a day trader, I always felt that I had a good imagination for what the moves could be. And really, mostly S&P, a majority of my career. I'm trading different markets now, but the markets that I trade, I always say, build a relationship with that market, understand how it moves on a regular day, on a busy day, right? On a slow day with data.
Yeah.
How does it move during all sorts of different situations that occur throughout the time that you've been watching that market? And that's what makes Bitcoin and Ethereum so difficult for me as a trader, because I'm not a hodler. I just don't sit there and hold this stuff. I'm trading it. And I talked about this in my last podcast, and I'll talk about it again today. I trade Ethereum the most because I felt that with Ethereum, I can gauge the ranges the most. And that is now even really changing for me. I'm looking at it the other day, like you said, it was 33% peak to trough. I'm like, this thing is getting chopped down by a third in a day. I don't have the vision for that, And when you're managing risk, and for me, because I'm doing it a little bit different than I'm doing my regular day trading future stuff. I'm trading a little bit actually more spot, because they've just gotten so volatile that I think sometimes the futures can be a little bit different, be a little bit difficult to try and hold through that volatility. So you go to the spot. But that to me is just so challenging. When someone like you, how many contracts are you trading a day? You don't have to give us, the exact amount, but I know you're trading a lot.
Yeah, it's, probably over 1,000 a day on Ethereum and close to 50 to 100 a day on Bitcoin.
And it's like, when you think about that, and, like I said, I'm a little guy, I'm a day trader trading this stuff. How are you managing risk with those kinds of size of positions? Because you're running a hedge fund, right? How are you doing that?
Well, for us, the nature of obviously running a hedge fund is that we are core holding, a position in both Bitcoin and Ethereum where we're long. So for me, the judgment call is really getting into how to assess the type of net exposure that we have on a day-to-day basis. And we look at all kinds of things, but the metrics that we look at are going to include things like a standard deviation move, trying to get a feel for what the range is. So, I know that the average monthly range on Bitcoin is 33%. That's a stark difference from trading an Apple or a Tesla. And I know that Bitcoin returned 400% last year, and ETH did almost double that at 798% last year. So you certainly have to retrain yourself just to understand sort of your levels and that expectation, right? But that said, when we do have these large positions on, the question is, how are we both capturing some of this upside but mitigating our downside risk? So looking into the option market for things like the implied vol levels. So We use a great service, skew.com. I'm sure other traders are using it, but looking at where the implied vol has been. So, last weekend I'm looking at it and it's gotten very compressed, and that's a great time to go, hey, protection's cheap right now. So let's get a little bit heavier on our downside protection. It also happened to be that Bitcoin's up the 85% in a month. So that's a time when we're going to obviously protect a little bit heavier and manage our hedge ratio at a higher level. So it's the game that we're playing it's a different underlying asset class, but the rules of the game are similar in terms of, for us, it's always capital preservation and making sure that we have the appropriate delta exposure, or I'll say gamma exposure on the downside, so that you get these outsized down moves. Ideally, that's something that for me, I actually look forward to. It's hard to train yourself to do that, but I've certainly been a contrarian by nature for a long time in terms of managing a hedge fund. So, it's a hard game to play because you're basically betting against yourself all the time, right? And if you're in a specific asset, and I think you've probably focused a lot on like Russell E-mini futures, but you get to know that market so well that you can you understand what those ranges look like right from the onset of the day, and you can almost I don't want to say feel, but you get a very innate understanding of how this market starts to move, and also what is overbought and what is oversold. So when we blast through 50,000 because Musk announces a 1.5 billion buy for Tesla, I know that the fundamental or the macro news is sounding very bullish, but I'm also looking at, we were up 50% on the month when that news was released. And when we blew through and went straight to 58, we were getting more short because it's one of those outsized events that, I'm looking at almost a 3 standard deviation move. And that's the kind of thing. It's really about finding the data that's meaningful and bringing that into your own sort of best practices.
So you trade long and short?
Yeah, we're trading long and short. We're essentially, we're always net long. We're very big believers in the space as a whole, and in that sense, we are the hodler. We are we're long because we look at the fundamental story, right? We look at, there's wide scale institutional adoption that's happening, but really we're just scratching the surface. And we're probably in line with a lot of the longer term price projections for Bitcoin. I know JP Morgan's note was they put a target at like 146,000, and if you follow things like stock to flow models, they've got price targets that can go up to 250,000 by Q1 of next year. So I'm always conservative. I think I'm always the voice that's like, let's just settle down what we're expecting here. I try and undershoot it a little bit because I come from that traditional finance world where 100% gain in a year is sort of outrageous. And, if we can tamper our expectations a little bit, I think ultimately we can, save investors some money and protect ourselves a little bit better. So it's hard to be conservative in this world, though. I mean, God, it just,
exactly.
Everybody's, yeah.
It is, right? I mean, but I always say, look, you have to stick to who you are and what you do. And,
Correct.
when we listen to everything that's going on outside of us right now, which is, I would say a vast majority of it is a load of BS, right? I mean, most of these people are not doing as well as they're saying. And I've been doing this a long time. It's never that easy. And if it is, it won't last long. And then they'll potentially give it back just as quick as they've made it, if not quicker and more.
Yeah. Oh, absolutely.
Going back to when you said, you said you wouldn't say feel, but see, I would say feel. Like for me, that has been the biggest challenge because I get into this stuff here, and I'm going to tell you my strategy. I want to hear what yours is, right? Because obviously your strategy matters a lot more than what mine is. But my strategy really for Bitcoin and Ethereum, mostly Ethereum, is I just try to buy the blow off breaks. That's it. I mean, I don't trade it short. And when they just rip down, I look for them to get to my key areas of support, and I just try to manage my risk. I mean, really, that's it, because I can't trade these things on breakouts to the upside. It's just not who I am. Similar to you, I like the contrarian, so I like the moves that come down. And it was like this Ethereum. I bought it the other day, and I'm using spot. I'm getting in, clipping in, clipping in. I got this range. I mean, I'm clipping in, and next thing you know, I'm clipping out because it's just blowing right through where my risk parameter was. I'm going, this is unbelievable, and it just happens so much more often in that. But then when I do catch them, I try to ride them and hold them. But that's my basic strategy. That's what I try to do. What is yours?
I think that's no. I mean, I think you're spot on with that. And maybe the best analogy, it's kind of like that "don't fight the Fed" analogy, right? Like when the Fed's pumping money, you want to get long. You want to get long equities because risk is cheap. And I look at the Bitcoin and Ethereum the same way. Shorting it is not a pleasant experience.
No,
you can
I won't
get
do it.
absolutely smashed shorting it. And, for that reason, I think if you're going to trade it, or especially day trade it, do it with a long bias. Like I said, we're net long. We're always going to be net long. We're just managing how long we are at any given time. So, it's the same thing. I try not to talk too much in the derivative language, talking about delta and Greeks and that kind of stuff, but it's sizing in and sizing out, right? You're cost averaging in when you're hitting that 1,500 ETH price yesterday, and you start sizing out when you're hitting the 1,750. It's that same sort of mindset that there's tons of opportunity, but I would not be net shorting these things. That's just a recipe for pain right now.
I don't have the stomach for it, man.
I don't either.
I mean, I just can't do it.
I don't either.
I just pick the one side and I wait. I have like I said, I have the days where I see it's just getting crushed, and I'm like, okay, I'll step in and pick some up here.
Yeah, exactly.
You mentioned fundamentals. You said that the fundamentals didn't make sense when the Elon Musk tweet had come out. I only really look at technicals, and we talked about how simple and basic my strategy is. What are you using to look at fundamentals in Bitcoin?
So, I mean, we look at some macro stuff, which I think a lot of the macro analysis we do is based on the stock to flow model. And I don't know if that's something that, are you familiar with the stock to flow model? Does that ring any bells? It's essentially, it's a model that's used to, assess the total value of any sort of finite resource. So gold, diamonds, real estate, it's all this kind of thing. And it basically says, there's this much that exists in the world, and there's this much that's being produced. And the rate of production is, it's going to take a certain amount of time. So there's a finite amount of Bitcoin, there's 21 million, and this is how fast it's being mined. Over time, that gets reduced in terms of the reward every 4 years, or 210,000 blocks. And as that happens, the price tends to appreciate exponentially because there's a reduction in the reward. So this halving, which is what it's called, just happened recently in May of 2020. And the following months after that is when there typically is this 10 to 20x rise in price. It happened in 2012, it happened in 2016. And we're looking at that as one baseline sort of fundamental analysis of why the price will appreciate, because obviously as supply goes down, that's when you start to see these massive price movements. On top of that, we look at the demand side. So, we're looking and we're watching these stories of corporate adoption and institutional players. So, I try and follow the thought leaders in any asset space. But when you have the Black Rocks of the world, and the Goldman Sachs and the Ray Dalios and the Mass Mutuals all starting to change their tune and now become sort of Bitcoin backers, that's a pretty drastic turn in terms of the sentiment for this space. Whereas before it was always sort of, shrugged off as this is a retail thing, or obviously it's very risky, it's very volatile. The reality is, it's volatile, but the majority of that volatility has been to the upside. And, it's not something that, I never recommend that people, over allocate if sizing any position correctly. So, even if you put a small percentage of a portfolio in something that outperforms to the upside, Bitcoin's averaged 200% a year since it was launched in 2010. That's something where you don't have to put 10% in. You can just put 1% in, because it's going to contribute to the net alpha of your portfolio pretty significantly with just a tiptoe in. So Yeah,
Well, I got a bunch of other things I want to cover here. We're going to pause in just a moment for 30 seconds,
sure.
everybody. And when we
Yep,
come back, I want to start off with the question, why should someone use a hedge fund versus just being a hodler, right? I mean, you have a hedge fund
sure,
and you say most of the time you're just not long. So we're going to talk about that, how you use
sure.
futures markets, and then maybe we'll talk some technicals and where you potentially see
Cool.
this market going, this crypto market, and then we'll get into rapid fire. So hang tight, everybody. We'll be back in 30 seconds.
Get S&P 500 and NASDAQ 100 by the slice. Just 1/10 of the pie. Trade the tastiest index futures, micro E-mini options with TradeStation. Get a piece of the pie now.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
Welcome back, traders. Nate's still with us. Nate, I left everybody with this question that I was going to ask you, and it's, why should someone use a hedge fund versus being a hodler?
Sure. That's a great question. I think, the real value that we're going to provide to an investor in a hedge fund versus just being a hodler is protection. That's the number one goal of any hedge fund that's worth its weight. And, the reality of Bitcoin and digital assets, Ethereum, all these other guys, these altcoins, is that it's a very volatile space. And even though it pays if you're going to hold for, say, 1, 3, 5 years, there's a level of uncertainty that comes with buying into this marketplace, right? You could be a hodler and have bought in 2017 into the hype cycle, and you would have been in a drawdown for 3 years waiting for it to come back if you held on that long. So it's a hard thing to hold when you have, these potential drawdowns of 60% in 2020 and 80% in 2017. So I think that volatility is a big reason for it. I think the other thing to consider is that everybody right now is the genius if you're in Bitcoin, and I'm not taking away anything from those people, because I'm a firm believer in the space, the technology, the transformative power of blockchain. However, there is statistically long periods of times after these sort of halving events where about 18 months after, you tend to go sideways for a certain amount of time. And that's when, for us, we really expect to deliver alpha to investors, because one of the things that we're able to do is take advantage of derivative markets and collect implied volatility or collect some volatility premium when things really aren't doing anything, right? So, the long-term goal is to, one, is provide protection, because in the event that we get some sort of 60, 70, 80% down move, that's when we're really going to shine. We're going to have this sort of explosive protective component to the portfolio in the way of put premium that is going to save us while a lot of these other guys are drowning. And those are the pain points where you start to question everything about, do I stay in this thing, right? Am I going to give up 80% or whatever? And I think if I'll say more retail guys probably have the luxury of being able to hold on, but certainly for institutional level clients, they just can't manage that kind of volatility on a balance sheet. Like, and kudos to the Teslas and the Michael Saylors of the world. They probably got in at a price that, hopefully we won't see too many dips below the 30 and 40,000 level. But, for corporate treasury guys, think about, they want to put some cash on their balance sheet into a Bitcoin or Ethereum. They can't have 40% of that just disappear overnight. That's get me out of this thing. I never should have been here in the first place. And it's like, it's just, then they've got they've got shareholders to answer to that are saying, what the hell were you guys thinking? So, there's some responsibility that we're trying to lend. And, we always say it's kind of a joke, but really we're being serious when we say we're trying to make something that's pretty wild a little bit more boring. Our goal isn't to take 100% of the upside, because, there's value in adding some protection to a portfolio. And in a space where you're looking at a 200, 300, 400% return, I'm fine making 350% of that if it means I'm not losing 70% on the downside. So we're willing to give up some of that upside because we're interested in protecting ourselves and investors against these massive sort of left tail black swan events.
It's funny actually hearing a hedge fund manager actually hedging positions. It doesn't seem like.
I know. Yeah, I know, right? Yeah, it's
Boy, that's a thought,
pretty novel
right?
idea. Yeah, pretty novel.
Reducing volatility, capturing alpha when things are range bound. I mean, like I said, for me, going back to kind of where we started, traditional finance people, especially people managing money, a lot of the guys I know, guys I'll play golf with, they look at this. They really struggle to be able to manage risk in crypto because they don't have, once again, going back to what I said, they don't even, they visually can't even see these ranges coming, right? I mean, nobody really can, but until you get into it and really understand how to do it, like, I mean, like you said, you went from day trading derivatives. I think that's a great place to start. I think that really helped me coming into crypto because I was used to volatility, not this kind of volatility, but you figure it out. Right. I think a lot of people just really can't. I think that's why a lot of people are actually just hodlers, holders of these things, because they're just going, forget it. I mean, I got to just be in. I'm not even going to think about this. Right. And I do think that there's, it's funny. When I first heard people starting hedge funds or funds on crypto, I kind of chuckled at this and I said, just buy it. I mean, what are they going to do? All they can do is just buy it, right?
That's what most of them do, honestly.
Right. That's exactly what you're thinking. I'm going to give this person my money. They're going to take a percentage. They're going to buy it. If it goes up, great. If it doesn't, they don't lose any money. But what you're actually doing, to me, is the way that I think that crypto should be managed, especially if you have a big portfolio. And like I allocate some of my money towards crypto. I'm day trading it. Like I'm not. I wish I was always net long through all of this. It's gotten a little hard for me to do that, but. It's a great answer, and I think that's, like we said, it's just interesting hearing somebody who's a hedge fund manager actually hedging stuff.
I mean, I think that's having that discipline and that mindset. I love the podcast you did, I think with Mark Randall, but talking about that alpha mindset, and really just gets down to it's discipline, right? And it's the hardest thing in the world as a fund manager to be essentially adding a short position to something like a Bitcoin and Ethereum when I'm watching it go to 85% this, just intra-month. And then you're watching the Twitter sphere where people are changing all their eyes to go in red laser beams. And you're like, that to me, I was like, okay, that if there was a signal on a social media, red laser beam eyes are definitely my signal to short this thing, because it's just, that is the epitome of a hype cycle. And it's the kind of thing you have to be able to remove you from, and you have to be able to have that trading discipline to go, stick to my guns here. What are the fundamentals telling me? What are the statistics telling me? This thing is, we're 3 standard deviations move into a single month. And, this just says, hey, I might be wrong, but, statistically, I've got a pretty good shot at this thing coming down. And, sure enough, it does.
What is that red laser eye thing? I saw a little bit of it on Twitter. I'm not caught up on it.
I was reading about it today. It was like red laser eyes until 100K. Which to me, I'm like, we just got to 50, guys. Like, what are we're already talking about 100? Like, give it a minute. But
I mean, I can't keep up with the stuff. You got diamond hands, you've got red eye. I don't know what I mean,
I know.
Dogecoin to the moon. I mean, I saw that tweet with Elon Musk. He put a picture of the Dogecoin guy on the moon. I think it said definitely or something. I'm like, this guy is. He's a piece of work.
You've got to be able to separate the noise. It's just like anything else. That's why I'll say it 100 more times, but it's data. If I'm looking at Twitter, I'm watching whale alert, which is telling me like, hey, we've got big coin transfers out of a certain wallet. All right, that's data. Red laser eyes, that doesn't tell me anything.
No. So Ethereum versus Bitcoin. I just did a podcast where I really understood a lot more about Ethereum and how you actually have to, or there's people out there that actually are they're paying every day to use it. He said like gas or something. Once again, this is above my pay grade, but they're using people that are using Ethereum. It actually had a utility crypto, and they're using it to pay every day. So people actually have to own Ethereum to pay. That's not the same case with Bitcoin. Am I wrong on that?
Correct.
Okay.
No, you're right. That's totally.
So doesn't that make, call me crazy, but doesn't that make Ethereum really the crypto that I would be if I'm a holder, right? That I would want to be in, because there's actually people continuing to have to buy it because they could actually use it. They're actually using it. Bitcoin, I don't know what anybody's using it for.
I mean, I think, it's a great thing to take a look at, because, there's two sides to that coin, right? Just in terms of the gas fee or that sort of utility tax. One side is, yes, it's generating some sort of monetary, some sort of income, but at the same time, it's inefficient in terms of Ethereum as a platform. And that's, I think, and I'm not the biggest expert on the altcoins and that kind of stuff, but there's obviously other coins out there that are more efficient, and people will talk about those and try and run those up, the Polkadots and the Cardanos of the world. But I think, with Ethereum, the way that we like to explain it when we talk about it is Ethereum is like a platform, or more like a commodity like oil, right? Oil is, yes, it's transactional and it can be bought and sold just on an oil market, but then it has all these use cases as a materials product, right? You can build plastic, which is a whole nother thing. You can build solvents and adhesives and lubricants and all these other things. And Ethereum is very much like that, where it's got huge wide scale applications. It's a global computer. It's it's the basis for other cryptocurrencies are built on top of Ethereum. So
Exactly.
that's one of the reasons we like it, just as a as sort of an alternative asset to Bitcoin. And then Bitcoin, you're right. Is it used in transactions? Sure, but I think the best use case is it's the digital gold, right? It's a store of value. You buy and hold it. It's relatively inefficient in terms of the energy it takes to mine it, but you can buy and hold it, and it's going to be a new way to store value outside of the traditional gold, silver, palladium kind of play.
I mean, to me, it's just pure speculation. Obviously, I mean, that's what we do anyway. We speculate, and I'm fine with it.
Right.
I mean, I understand that. I mean, I trade gold all the time. I'm not using gold, but I buy gold, right?
Yeah.
But for me, it's kind of I'm more aggressive with buying Ethereum on the dips as a trader, because I do feel like somebody who actually is looking to buy it, that needs it, that uses it, there's just a different support level there with those traders. Maybe they're not necessarily trading it, but they're actually going to be buying it. And that's kind of another reason why I use it as my day trading crypto market over Bitcoin. Because I just think that, once again, I look at it and go, does somebody need this? Oh, they do. So maybe if it hits a level of support. And I want to talk about technicals a little bit, because we talked about fundamentals. We talked a little bit about your process. But what technicals are you using, if any? I mean, walk us through a scenario where, you were talking a little bit about Ethereum, maybe picking it up at 1,500 and maybe selling some again at 1,700. What was the reasoning behind that?
So, I mean, I think the majority of the technicals are stuff that we've really generated in-house, so to speak, because I'm probably maybe a little bit old school in that I used to have so many charts where I could barely see the actual price action because I'd have so many technical indicators laying on top of it. I'm sure you can relate to that kind of thing, but I very much got to a point where I was looking a lot more at price action, volume. Occasionally I do look at moving averages, although I think they're more utilitarian in traditional finance versus Bitcoin and Ethereum. One of the things I definitely look at is some of the statistical data around standard deviation. So that's a big, I'll say sort of flag in terms of when we like to be long and short or add long and short exposure. So when we see, I'll say outside of a 2 standard deviation move on Bitcoin, we measure the frequency of how often this happens. So, 33% of the months out there, you get a greater than a 1 standard deviation move on Bitcoin. So it tells me that if I start to see, a move outside of that, certainly 2, that's when we start to, add additional short premium or short exposure into those sort of movements. The other sort of fundamental things, or I guess more technical, are going to be where the volatility markets are. So not only do we have to determine how to or what to short or to what degree, but how to do it. So in a world where prices are high and volatility is low, I'm a net buyer of premium because I want to buy my premium cheap. So I'm the put buyer in that scenario. A week ago, premium was very cheap. Today, vols, on the 1 week and the 1 month spiked from, about 100 to 150%. And that's when we want to be net premium sellers. So I might be selling calls to add short premium, and we're even selling some short puts outside of what we own to sort of capture some of the vega or the volatility premium in the derivative market. So that's how we're constantly adjusting, and it's not an easy needle to thread by any stretch. But those are the kind of things we're always watching. The derivative market is kind of our indicator of where things are going. You can look at open interest on certain strikes. We look at that a whole lot. And then when we see certain statistics start to sort of become an outlier, that's when we want to put positions in certain areas. So, when the 40,000 put on Bitcoin got really cheap, we started buying them because it's a cheap way to protect the entire portfolio.
Got it. Yeah, I mean, I use Bollinger Bands. You talked about standard deviation moves. That's why I like them too. When they start getting,
I love Bollinger Bands.
And I was looking at Ethereum when it was blowing through my bottom Bollinger Band by a lot.
Yeah.
It was one of those things where I'm like, that to me is just showing, it's mini capitulations, So that's similar to what I look at. I use the 3 standard deviation Bollinger Band. Most people know that I use that all the time. And when I see them get outside of that, I'm going, okay, that's why it's hard for me a lot of times to gauge stops, because what I'll do is I'll start slowly accumulating in there using spot. The only time I'll use futures is if I feel like it's really close to a risk area. And that brings me to really my next question is, you use futures and spot. What would make you decide to use the futures over spot in a situation?
So the futures, same sort of thing. We're going to generally be using as a tool to add short premium or short delta exposure. So we're always holding our core, but we're going to use futures. And it's a use case where if you want a 1 delta short, essentially, you can't generally get that in a derivative market unless you're selling a deep in the money call, or you're doing a risk reversal, or you're selling a call, buying a put, but that's expensive usually. So when we see that 3 standard deviation move, that's when we would be selling some of the futures, and we're usually selling a 1 to 2 month out. But that's sort of the extreme when we see that very, very much an outlier move to the upside or downside. That's when we're going to add a little bit of futures exposure. And the other one, I think you probably have talked about this in another one, but the fib retracement is another thing that I do look at a lot. So I think I heard you talk about it on an hourly chart, but looking at that 3 standard deviation Bollinger Band, and then you start to come in and break through your 70%. That's something that I've looked at as well. And I like that as an indicator. Also, looking at sort of some of the historical moves. If you look at the run up on Bitcoin and Ethereum, they did their run up and they both hit a 50% retrace, almost on the money. So those kind of things, it's not the only thing that we're going to look at, but I like to do what's called signaling. So if I have 4 signals that are going off, it's saying, all right, you got a 50% retrace, you've got a collapse in vol premium here, that's a time where you're going to start to change your delta to be either more long or more short.
Yeah, I mean, I like it. Like, I go back to my strategy. It's simple. I like to buy the pain. I don't know what else to say it. I mean, that's why I use the tools to say, how extreme is this, right? Just give me a gauge as to what it is. And then I just start peeling my way in. But it's interesting hearing it from you. Like I said, you're one of the players out there that are trading this, with size on a regular basis. And, so it was great perspective hearing that from you. But this whole conversation, a lot of fun today. But we aren't done yet. Man. I've got some rapid fire questions next if you're ready for those.
Yeah, I'm ready. Go ahead.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Learn more at tryttnow.com. Nate, first question for you. What trader has influenced your life the most and why?
I've got to say Tom Sosnoff. So I don't know if you're familiar with ThinkorSwim and now TastyTrade.com. When I got introduced to him, I was still buying a lot of volatility premium, and he really flipped the script for me to become more of a premium seller, to look at things like implied volatility as indicators. And I just completely upped my game in the derivative trading world. So shout out to Tom and Tony on TastyTrade. Those guys are awesome.
What was one of the hardest things for you to overcome in trading?
The number one thing is definitely my ego. I think, associating loss with some sort of personal, well-being or something like that, knowing that taking a loss is not a reflection of me as a person, it's just a wise thing to do when you can minimize that loss. That's the best thing. And trying to separate my ego from my, my trading persona was a hard thing to do, but I'm working on it every day.
We all are.
Yeah.
Normally I ask everybody, how has your trading process evolved over the years? I want to change it up a little bit today with you
Sure.
and say, how has your trading process changed from being a derivatives day trader to a crypto trader?
Sure. I think before, when I was a derivative trader in traditional equities, I was chasing a lot of, I was doing a lot of different strategies. So I used to run like a binary strategy or known events like an earnings play. We'd sell volatility premium on just about anything in the S&P 500. And that could mean we were trading, we'd have 50 underlyings on at any given time. And it was very difficult to manage. And as I transitioned into really, say professional, but now derivative asset or, digital assets, we have focused our attention on really just two things now. And that laser focus is one of the, the biggest contributing factors to my and our success as a fund is, it's find that thing that you do well and just do that. So it doesn't matter if you're trading E-minis or, gold or, DXY, it's finding that thing that you do and do that one really, really well.
What is one attribute that you believe every crypto trader should have?
Humility. You know what I mean? It's too many people that think they're geniuses right now. And it's days like today and yesterday that will teach you very quickly that you're not.
Favorite book about trading?
Fooled by Randomness, Nassim Taleb. He's written a lot
Good
of different stuff, but yeah, I mean, that same sort of thing. It's one of the things that helped me stay humble, but knowing that, you can measure a lot of probabilities, but there's always that random event out there that can happen. And accounting for that is a way to make sure you stay hedged and don't assume that you're going to be right.
Best piece of advice you received about trading?
I think, when I was early, one of the guys that I was trading with on a desk said, make a decision before you're forced to make a decision. And that has always stuck with me. It's the same way to translate trade your plan. But if you're forced to make a decision, you're in the crowd that you do not want to be associated with, right? You're getting liquidated. You're covering some short position that has just met or exceeded max pain. So know your plan and make those decisions before you're forced to.
Last question for today. If you had an elevator pitch me your edge in trading crypto, what would you say?
I think intelligent exposure to digital assets is the way to go. This is an extremely volatile market, and the best thing you can do, rather than try to ride some of the extreme ups and downs, is have a professional manager hold for you, manage the volatility, and you'll be happy with the outcome.
Nate, this was awesome, man. I learned a ton. It was great hearing your perspective. I think you're the first person I've talked to on the show that is an active day trader, hedge fund in cryptos, and just great hearing from you today. I learned a lot. Where can people learn more about you?
You can find me on Twitter. It's Nathaniel J. Cox, or you can check out our website. It's 2prime.io and 2prime.com. So we're super excited. It's a wild time to be a part of the digital asset space, but hopefully that's something that we can make a little bit more boring by adding, some intelligent management.
Quick question before I let you go.
Sure.
For your hedge fund, can you be an independent? Are you guys only dealing with institutions? What's it take to get involved?
Yeah. High net worth individual. You just have to be an accredited investor. So, we do deal with a lot of high net worth, but family offices, corporate treasuries, maybe some sovereign treasuries at some point. But we'll welcome all of them.
Awesome, man. Well, thank you so much, Nate, for joining me on Futures Radio Show today.
Hey, thanks so much for having me. I really enjoyed it. Thanks, Anthony.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.